Hello there, this is Clifford from Clifford Odhiambo and Company Advocates. We are located at Junior Place along Lenana Road in Kilimani. In this weekly case law review, we analyze a recent judgment of the High Court of Kenya in the case of Commission of Domestic Taxes versus Gravity Trading Limited. The citation of this case is Nairobi Milimani High Court, Commercial and Tax Division, Income Tax Appeal number E72 of 2020. The judgment of this case was delivered by Honorable Justice Mabeya on the 16th of September 2022, and it answers the question whom between the Commissioner of Domestic Taxes and the taxpayer has the burden of proving or disproving the allegation of missing traders fraud. This case is an appeal to the High Court from a decision of the Tax Appeal Tribunal. The appellant in this case is the Commission of Domestic Taxes, who had assessed the respondent's tax returns for the period between June 2016 to November 2017 and made the conclusive finding that the respondent was the beneficiary of the missing trader scheme. Missing trader is a tax fraud in which a taxpayer submits tax invoices in its claim for input tax, whereas the tax invoices are inauthentic and the trader is missing. The truth of the matter is that the trader never received the goods claimed to have been supplied nor utilized the services claimed to have been offered. The genesis of this case can be traced to the Commissioner's assessment and demand for Kenya shillings 2 million for VAT and 3.7 million odd for corporate tax from the respondent. The respondent raised an objection to the assessment. However, this objection was dismissed by the Commissioner. This prompted the respondent to file an appeal before the Tax Appeals Tribunal, which came to its aid when it set aside the Commissioner's tax assessment of the respondent. Dissatisfied with the decision of the Tax Appeal Tribunal, the Commissioner filed an appeal to the High Court, and this is where we pick up this case from. In the appeal, the Commission of Domestic Taxes raised several grounds of appeal, key among them being that the tribunal had failed to consider the provisions of the VAT Act, which requires a taxpayer to maintain a 5-year record of its transactions, that the tribunal had failed to make a finding that there was VAT loss, and further that the tribunal had failed to consider the evidence before shifting the burden of proving the fraud of missing trader upon the Commission of Domestic Taxes, contrary to the provisions of the Tax Appeals Tribunal Act. In response to the appeal, the respondent contended that it was not true that the traders were fictitious nor missing, as they had received the goods that were supplied and had received invoices and delivery notes from the suppliers, and further that it had made payments to these suppliers, majority of whom having been paid through direct bank transfers. During the hearing of the appeal, the respondent company argued that the Commission of Domestic Taxes had failed to adduce as evidence the investigation report in a bid to substantiate the allegations of missing trader fraud. In any event, the company argued the law did not require it to provide details of its suppliers, as they were already registered by the appellant as their agents for VAT purposes. At this juncture, it's perhaps important to point out that at the end of each tax period, a registered person is expected to submit a return detailing the deduction of the input tax for the period from the output tax. Often, where the input tax exceeds the output tax, the difference is deducted from the next tax period or claimed as a refund from the Commissioner. It is to be remembered that Section 2 of the VAT Act defines input tax in essence as being the VAT that is charged on the purchase of taxable purchases and expenses for business purposes. In this case, the Commission of Domestic Taxes had argued that the traders whom the respondent company claimed input tax from were not registered persons, contrary to the provisions of the VAT Act. Section 42 of the VAT Act states that a registered person who makes a taxable supply shall at the time of the supply furnish a purchaser with a tax invoice giving details of the supply. The Act further states that such a tax invoice should not be issued by a person who is not registered. During the hearing of the case, the Commission of Domestic Taxes argued that the respondent company had failed to demonstrate how the purchased goods were ordered, recorded, and sold. He maintained that the suppliers were fictitious and that the respondent company was part of an elaborate scheme to defraud the government of revenue. He further argued that the respondent company had only produced ETR receipts but had failed to adduce notes and records of stock. The respondent company's defense argued that it had done its due diligence to ascertain the integrity of its suppliers, having received ETR receipts, confirmed that the ETR receipts had the names and the PIN numbers of the suppliers, and verified the PIN numbers of the suppliers from the iTax and further paid for the goods that were supplied and therefore was entitled to claim input tax. The court noted that the commissioner had requested the respondent company for additional documents, which request was never complied with. It was the court's view that upon such request for additional documents, that the evidentiary burden of proving missing traders shifted back to the respondent to discharge. It was for this reason why the court took issue with the findings of the Tax Appeal Tribunal that the commissioner did not enjoy the luxury of continuous demand of documents not listed under Section 17 of the VAT Act. On the contrary, it was the court's finding that under Section 53 of the VAT Act, a taxpayer is expected to keep a full and true written record of every transaction it enters into, either in English or Kiswahili, either written or in electronic format. In the case of Commissioner of Domestic Services versus Galaxy Tools Limited, 2021 EKLR, the court listed the additional documents that a taxpayer is expected to supply to the commissioner. Some of these additional documents include copies of records of stock, details of how the goods and services were supplied, among others. In this case, the court found that the commissioner, having pleaded that the transactions never took place, it was incumbent upon the respondent to disprove those allegations by providing additional documents, including preemptory documents, to prove its input tax claims. In the end, the court faulted the tribunal for failing to appreciate that the burden of proof rested on the taxpayer, that according to Section 30 of the Tax Appeal Tribunal Act, an appellant to the tribunal has the burden of proving that an assessment is excessive or a tax decision ought not to have been made or ought to have been made differently. By insinuating that it was merely sufficient for the commissioner to plead that a tax fraud had occurred and shifting the burden of proof on a taxpayer, the learned judge seems to have derogated from the High Court case of Vijay Murjaria versus Madhu Singh, 2000 EKLR, in which the Honorable Justice Tunoi had held that in allegations for fraud, one has to distinctly plead and prove them, and an allegation of fraud cannot be inferred from the facts. This case seems to place an obligation on a taxpayer to ensure that a supplier is registered before making a claim for input tax. Whether this obligation is undue on a taxpayer is going to be the subject of many discussions to come. Well, that's it for now. Hope to see you again next time.